ECB cuts yesterday. Markets are lower. Some of that may be the read on GDP. Remains to be seen. But there's a big question here in the United States. Does that ECB cut, does that push the Fed to cut sooner or later? What's your opinion?
I agree with the characterization of the hawkish cut for the ECB. If you're going to cut interest rates and it's widely expected, you need to give some kind of guidance as to when and why you might cut rates further. And if you don't, you're going to end up disappointing markets like the ECB did yesterday. For the Fed, if the ECB's hawkish cut means that the euro got stronger, that potentially means the dollar gets weaker, which is going to add to inflation and adds to some of the Fed's headaches. You do tend to see synchronicity, though, in the central bank's actions here around the world. You have the Bank of Canada cut, you have the Swiss National Bank cut, or the Swedish National Bank cut. You're potentially going to have the Bank of England cut. So they tend to happen together. This cycle hasn't been quite as synchronous as other ones, but the Fed is going to be, we think, cutting later this year, not necessarily for the reasons the markets are expecting, which is sort of benign disinflation, but because we are going to start to see, if not this morning, then in the next couple of months, more weakness in the labor market. It's going to force their hand and bring them to the table with interest rate cuts.
You know, good point. I think the Bank of England's almost certain based on what Andrew Bailey had to say during their last meeting. I want to turn back to the U.S., though. You're having some doubts about the U.S. achieving a soft landing. The thing that you're looking at is employment. I mean, straighten me out, because I don't quite get it. Sequentially, we're expected to see an increase in jobs. What are you seeing that economists in the market aren't seeing when it comes to the jobs market?
Sure. So the payrolls have been very strong, really, in the last year or 2 years, but we have seen sort of this gradual decline in job creation, which is going to be natural the later you get into a cycle. It's the leading indicators for employment that really concern us. When we look at leading indicators for the unemployment rate, because again, the unemployment rate is not a leading indicator. Once the unemployment rate is rising, it tends to mean it's already a little bit too late for the Fed to step in and help the market or help the economy with interest rate cuts. The unemployment rate is higher by about 0.5% than it was a year ago.
Yeah, but wage growth is higher as well. But wage growth is higher. So generally, if the labor market's softening, why would wage growth be so strong? I believe it's about 4% year over year. Why are we seeing wage growth if the labor market's actually soft?
So wage growth is also decelerating. So the two things that we look at together are the quits rate. So how often are people leaving their jobs voluntarily? And that tends to lead wage growth by about a year. And the quits rate's been coming down pretty rapidly over the last year as the market sort of normalizes, and even quits now are a little bit less common than they were before the pandemic. We think that's going to continue to bring wage growth down. That's a sign that the labor market is not as tight, despite the headline payroll growth. The labor market is not as tight as it was, again, a year ago. But things like small business hiring, how many small businesses are saying they're going to be hiring in the next 3 to 6 months, that's really started to come down pretty significantly as well. And that has been historically a very reliable indicator for a rising unemployment rate. So that's what we're concerned about over the summer is that
I want to switch gears to the markets, Brian. Before we go all the way to the summer, I want to switch to the markets right now, because I know you're looking at the markets currently right now. So quarter to date, I'm looking at the Russell down 3.5%, industrials down 3.25%, materials not far behind them. That's something that you're flagging that's saying, actually raising some questions in your mind about us reaching that so-called soft landing. But I do have to ask you, in the market at least, isn't that just a shift of investors going towards the AI trade and leaning even more into it? I mean, the money can't go everywhere at the same time.
Sure. So you certainly have tech sort of out there on its own, leading in large part because of the AI trade. But what we also see sort of the internals of the rest of the market are, again, if this was going to be a soft landing, if we were sort of at the early stages of sort of a new cycle, we should be seeing those cyclical sectors performing better. Instead, we're seeing sectors like utilities, REITs, consumer staples. Those are very interest rate sensitive sectors. In some respect, they're bond substitutes. They like lower interest rates and they don't mind slower economic growth. Those are the sectors that, again, outside of tech, have been in the lead in this latest kind of rally that we've been having. So we call that a risk-off rally. You tend to see that at a time when the Fed is holding interest rates high and waiting to see when it's appropriate to cut. By the time you get to those cuts, the market is typically starting to roll over as the bad economic news is coming in.